Could we see another rush now? The market could take a little bit of a slow turn while the market adapts to this. And then the following year in 2026, we could see things start to pick up. It's just so much going on right now that it'll be interesting to see why. Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow. And we're back for another round of how many more mortgage rules and changes can the government make before they blow up the system? Okay, no, I'm just joking. But ultimately, I have never seen the amount of home, real estate, and mortgage mandates and changes as we have in the last year, as I have had since I've started my entire career in the mortgage lending space. Obviously, real estate and home buying is an exceptionally hot topic right now. There's no doubt that virtually everybody has it on their agenda. The politicians, everyone thinking about buying a home, everyone who can't buy a home, everybody who wants to buy a home, and virtually anybody who owns a home. All they can think about right now is everything to do with mortgages, real estate, supply and demand. And so really, at the end of the day, why wouldn't it be appropriate for OSFI, which is the official governing body, so it's the Office of the Superintendent of Financial Institutions, why would it be appropriate for them to come down and give us a new rule to think about and chew on as we consider all the other potential things that they could be focusing on at this time right now? The new rules that we're talking about right now and we're going to talk about today are called LTI. And I know this is going to start off sounding really boring, but trust me, I'm going to make it really fun and interesting. And so if you want to know what the potential new rules could look like and could be, and the proposals are that are going to be coming down as early as spring of 2025, you're going to want to listen to this, because virtually anybody who has a mortgage or wants to get a mortgage, well, nobody really wants to get one, but wants to buy a home or needs a mortgage to purchase a property, is going to be impacted by the rules that are coming down today. Now, the big question mark is the ambiguity. They didn't really come down and say specifically exactly how the new rules are going to be impacted, but we have a really good guesstimate of what could be coming down. And so really today's conversation, if you're listening in, is going to be a focus on the different rules and regulations that could impact you and what that could mean for your home buying goals, refinancing goals, or just longevity of real estate in Canada in the next couple of years, the way that it was messaged to us. What's going on, guys? My name is Alex McFadyen, and as you guys probably already know at this point right now, I am obsessed with helping our clients create wealth in real estate, and that also includes looking at what's going on actively in the marketplace. Now, if you don't follow me already, I'm really on Instagram, way too much, but posting on a daily basis as at The Mortgage Pug or at Flow Mortgage Co. So make sure to follow me on there, or check out our YouTube channel at Flow Mortgage Co, where we go long form. And if you're listening to this podcast right now, you're primarily going to learn a little bit about what these new rules are going to mean to you, and more specifically, what else is happening in the real estate world. There's a couple other things that we're going to touch on today in this update episode, specifically around supply and demand and why Canada is having such a hard time building homes right now compared to 2006. Like, why can't we build any more homes? But we'll get to that afterwards. Today, to start off the phone call, we're going to focus primarily on an understanding of these new rules, what they could mean to us, and exactly how they might work. So, getting right into it, LTI, another acronym. Oh my gosh, as if there weren't enough acronyms in real estate as a whole. What the heck is it, and what does it mean, and what's going on, and who's doing it? So, let's give a little backstory. Obviously, one of the primary topics right now in the housing market specifically is quote unquote borrowing too much or being over leveraged, which is an interesting consideration because, back in 2006, 2005, people could get a 40-year mortgage that was insured with 100% down payment and a refinance up to 95%. So, to think that we have to add in more rules and regulations is an interesting concept and conversation, but they're doing it, or they're considering doing it in either case scenario. So, who's looking at making this change is the Office of the Superintendent of Financial Institutions, which is OSFI. They're the ones who are governing most Canadian institutions, which is primarily, when you think about mortgages, the big charter banks that you're looking at. So that's your TDs and your Scotias and BMOs and so forth. So these are the lenders that are mostly coming under fire. Most of your non-bank lenders, such as your monolines, First National, MCAP, and these types of lenders, they're already heavily regulated, and so it doesn't necessarily impact them directly because they already have a different pool of regulations that they fall under. Now, if you don't know this already, first and foremost, the primary way that most people qualify for a mortgage right now is based on debt to income. So if you make $100,000 a year or $150,000 a year, you can borrow up to, in this situation, 39% or 44% or sometimes higher as a total percentage of your income. And how they calculate that is they look at your gross income, depending on how it's calculated. They then add in your property taxes, your strata fees, any other debts like car loans or credit cards, and then they look at the mortgage payment, which is already stress tested. So they take the rate that you could potentially be getting, they add 2% to that, they figure out the payment. And so your debt ratio right now is already maxed out based on a stress test, and now they're saying that probably isn't enough. So let's break it down for you. So debt servicing is different than loan to income. The idea here, and the reason I'm saying idea is because a lot of these things are proposed, but they're not clearly articulated to us, maybe to the banks, but they haven't been clearly articulated to the government as to how they're going to look at this. So here's a quick little breakdown of what this looks like. So again, unlike an individual, debt to income ratio, like the stress test, the LTI itself measure applies specifically to lenders' overall mortgage portfolios. So your big bank may say, okay, we're gonna put $5 billion towards mortgage lending. So what this predominantly does is it says, well, we are actually going to put limits on how much of the loan to someone's income that you could lend towards these individuals or these people. Now, there's some gray areas, which includes, okay, how are they determining what these limits are, and who's determining what these limits are, and who's actually monitoring this. I'm sure that'll be ironed out in the wash, but just to keep going on that, the policy itself basically says that while no one borrower is restricted from having this loan to income ratio, which is meant to be 4.5 times their income, the lenders were going to have to regulate how much or the percentage of those loans which will sit in this portfolio. So let's rewind it back. The difference between debt servicing versus loan to value is that a debt servicing is based on your gross income and a percentage of your income going towards a property. So depending on what the interest rate is in the amortization, right now, I think the average individual's loan to income is less than 4.5%. It's probably close to 4.25 based on interest rates being higher, because the higher the payment, the less you qualify for. But if you were to consider, the lower rate environment, so back in 2021, when rates were, sub 3%, sub 2% in some situations, in those circumstances, the loan to income was close to 5 and 5.5 times someone's overall income. So that would definitely impact people from that perspective. Now, listening to later in this episode where I'm going to talk a little bit about specific scenarios and examples, where I'll go over what a loan to income looks like today, given today's situation, what someone could qualify for today with a regular conventional lender, and with a strong application potentially with a bank lender. And then last but not least, what would happen if rates were to drop, and how would that impact the LTI limits? Now, if you're still with me here, again, we're going to get into a little bit more stuff here. So basically, again, to make it clear, LTI is 4.5 times someone's income. So if you make $100,000 annually, they're basically saying, okay, you cannot borrow more than $450,000. But again, the suggestion is that this isn't necessarily for one individual borrower. This is for potentially like a group of loans, and there's going to be a percentage of these loans, again, not sure how it's going to be dictated, where they cannot be above these limits. So typically when these things happen, what it normally means is that the banks themselves are going to, in most circumstances, add their own different rules and regulations to determine what types of loans are going to be allowed above these 4.5 limits, so that they don't go over these numbers. And so what I mean by that is, as of today, someone with a 20% down payment and who is well capitalized, like has lots of cash, good credit, and perhaps they're putting down a large down payment of 25 or 35%, they could borrow up to 50% of their total debt servicing, and that is equal to more than 4.5 times LTI. Now, what we might see, and this is just a projection, is that after these rules come into effect, there might be some more strict guidelines on who could borrow more than the typical 39 or 44% of someone's overall debt income, and who could go up to that amount. So from a practical implication perspective, really what this will probably mean is reductions in approval mortgage rates if rates were to come down. under the current conditions such as they are right now, you could see a significant reductions in the new rules, but again, probably not until rates were to go, say, sub 4%. And I think that's one of the big things that the government is really guarding against. I mean, let's be honest, with rates being such as they are, the fact that home values are remaining where they are and people are making their payments talks about Canadians' resilience and desire to be able to pay off their mortgage. Ultimately speaking, the biggest fear, and one of the reasons that the Bank of Canada has not dropped rates, is they're afraid of the market really taking off and people, quote unquote, borrowing too much money or more money, which ultimately means that they're trying to protect against the future. And they're trying to think about, okay, down the road in 1 year or 2 years or 3 years, what does it mean if rates were to come down? Are people going to be borrowing a significant amount again? And if things were to fluctuate, how do we protect against that? So couple stats right now, the median loan to income for people who have more than 20% equity in their property or 20% down is currently 2.6 times, with only 12.5% of uninsured borrowers having an LTI over 4.5x, which basically suggests that the new rule is only going to impact a minority of borrowers. The thing to note about that is I would argue that the 12.5% are probably people that are buying right now, or they're buying their first property or second property, or early in their house shopping days. And they're probably people who are in the higher cost markets, whether that be Toronto and the surrounding areas, Vancouver and surrounding areas, and things like that. And that's typically the reality of these markets and what we've seen historically speaking. It's not clear as to who out of that 13% of borrowers are the ones that are impacted and where they're from. Some other considerations to think about is like, how does this affect potential investors or people who want to invest who can cover their debt no problem, even with rental income, but they have these other loans in their name? And what does this mean for them? Will they be affected based on their overall portfolio? And if so, how will they look at regulating those numbers? That's another interesting consideration, because as you may know, it's mostly been the federally regulated institutions like banks that have taken on a big chunk of those loans since 2016, 2017, when they changed the whole way that the portfolio insurance program works. We'll do a separate podcast on all that stuff, but in short, the banks are the ones that are doing a vast majority of the investor loans. The thing is, like, people who are going to be affected by the new rules, they might need to qualify as better than average customers, which basically means we could see people who are affected who have a good income, good family income, but basically need to borrow the extra money. There could be rate premiums. We could see situations where they need to work with non-federally regulated lenders. So this could be alternative lenders. And I truly believe that there's going to be a new gap in the marketplace there that opens up where people are AAA well qualified, where there's just a slight premium as opposed to a larger gap with alternate lenders. And I think that world is going to continue to grow as these other banks become more regulated, which people are going to want to borrow the money if they want to make the move, as long as it's not a ridiculous cost. At the end of the day, I think that that's probably one of the real outcomes here, is that people are going to consider looking at alternative options, which again says that people need to be working with someone who, like us, like as a broker, is working with a variety of different institutions so that we can look at the different ways that they're qualified. There's lenders that will qualify you for 50 and 55% of your total debt servicing right now under different guidelines and rules, but most people just don't know about them, so they don't even go down this road. So let's talk a little about timeline. So the first thing is the timeline itself of this actual event is going to be coming down in spring of next year. We understand that we're probably going to get more feedback towards the second half of the year as far as specifically how the LTI limits are going to be put in place. And it probably won't be the case that we won't actually hear from any of the banks as to how they're going to regulate it and what they're going to do until spring of next year. One of the things that I consider is that, typically speaking, most of these lenders will err on the side of caution more than anything else as they try to understand how to use the different programs that will be put in place and the different regulations, which could mean that spring of next year, even with the potential of lower interest rates, we see a lot of the banks start to pull back a little bit, which means lower qualifying amounts, and it'll be interesting to see if and how that could impact the market. Now, I mean, all things considered, it is a good reminder that they're having different rules and regulations similar or in variances of this that have been put in the past before. I mean, just think about the stress test as an example. And while there was a temporary impact on the marketplace, the marketplace as a whole expanded to overcome all of these different options. the stress test is a good example of that because there was a period of time for about 3 to 6 months when the stress test was put in place, like think 2019. And for that first half of that year, it was relatively slow. In fact, I would argue that most of 2019, not factoring in that interest rates themselves went up, but you also had the stress test and you had a rush to the market before this happened. Could we see another rush now? The market could take a little bit of a slow turn while the market adapts to this. And then the following year, in 2026, we could see things start to pick up. There's a lot of things coming ahead during that time, whether it be the election, potential of interest rates coming down, the potential of renewals coming up. It's just so much going on right now that it'll be interesting to see why and how they have made these different rule changes right now in the middle of everything else that's going on in the marketplace. The long and the short of it is more changes, more adjustments. There's always something fun going on here. Other questions that I would love to know is obviously how are they calculating income? Will they be calculating it based on personal income? What if you're a business owner? Is it going to be based on your business income or incorporated income? Take more money, obviously, from your corporation, pay more taxes. What does that look like? Because again, I think you're squeezing the business owners, you're squeezing the people who are trying to get into the marketplace, who are making that move up, and you're not obviously impacting those who have money or those who have built the equity in the property over time. So a couple of real life examples, thanks to our friend Bruno there at RMG Mortgages, sent these over to us today to have a quick little peek at some real life scenarios. I mean, an interesting point that he made is this could actually level the playing field for conventional banks with non-bank lenders who are already pretty heavily regulated. And again, even if it does reduce the qualifying amount, it could create a better amount of competition in the marketplace, assuming the banks do have a greater amount of regulation. One of the reasons for that is that banks have the freedom today that if you're putting 20% or more down, if you're a good client, they can borrow you up to 44, lend you 44, 46, 48, and up to 50% of your total debt, whereas these lenders are capped out at 39%. And so ultimately, they end up doing a lot of the high ratio or less than 20% down mortgages where the banks get a lot of the 20% or more, which is almost like a very unfair advantage. So a few examples here. You're going to have to visualize this. So lots of numbers to think about. First of all, scenario one is based on 4.5x income. So considering a property value of $1 million and a mortgage of 80% loan to value, so that's 20% down payment, thinking about a rate today at 5%, so a stress test of 7%, with someone looking to borrow $800,000, the annual income required would be $177,770, payment of $58.94. So that's $177,000. In scenario two, which is like today's real life regulations with those particular lenders, so exactly the same, we're not using LTI, okay, we're actually going to use the debt servicing regulation. That person would actually need to have $181,000. So basically, your current non-bank related lenders today would actually need to get a higher amount of income compared to the LTI requirements. Now, if we were working with a federally regulated bank and you have a really strong application, it is possible that you could qualify for $800,000 with as little as $141,000, but probably closer to $155,000 of income today, which is dramatically different before the LTI rules took effect. So as of right now, income required is closer to approximately $141,000 to $155,000 of income with a federally regulated bank, given the current debt ratio qualifications. Now, if rates were to drop, okay, all things being equal, that first lender, so the non-bank lender, to get to your $800,000, if rates were to go, say, 3.5%, if you're still following me here, you need about $158K worth of income. So let's just track this back, basically. As of right now, the non-bank lender needs about $180K worth of income if rates were to come down and go to $158. With the new rules, the playing field, no matter what, would be virtually level, where to get to $800,000 of income, you'd need $177,000 of income required. That equates to almost a $40,000 difference to qualify today on today's rates with a conventional bank for $800,000. $40,000. That is massive and could have a huge impact and implication on what people could do if these LTI rules are put into effect. There's just like no way, there's zero way to understate that in all ways of the overall situation. Like that is a huge potential impact. Now, before you get excited and you run out and you say, okay, well, this is reality, I got to go qualify today. A couple things to keep in mind. First and foremost, this is subjective because we don't know that the rules are in fact, coming into play. We don't know this to be true yet, and we don't know how they're going to be invoked, but just using the numbers as they are right now, that's a real breakdown, a real number. And so, for someone who is looking to take advantage of the current market, who is an investor or who is looking to borrow to their, quote unquote maximum before property values potentially go up, that is something to keep in mind because this could impact a lot of things. Could it stagnate the real estate market? Potentially. Could it cause an impact on what people can do at renewal or refinance time? Definitely. And so I think there's just a lot of unknowns that need to be addressed and need to be answered. So we're going to stay on this topic with LTIs because there's a lot to dig into, and it's definitely something that you as a potential mortgage borrower or homeowner need to hear about, whether you're an investor or whatnot. But before we end this episode, we want to talk about a few key things. We're not going to get into GDP today. I just want to talk about some interesting stats that were sent my way, and you're going to eat this up really quickly. I found a chart. So the primary issue, I think we can all agree that one of the primary issues right now in Canada is that we don't build enough homes. And we don't even build enough of the right homes. So that's the primary issue. So I found this chart back in 2006, and we're sitting here looking at in 2006 compared to today. Okay, so we have 13.1, sorry, my apologies. Let's start that over one more time. In 1990, let's go back here. I'm going to go over some other stats. So in 1990, Canada had 276,000 and change housing starts with 26.9 million people. So that's 276,000 housing starts in 1990. And actually, funny enough, in 1990, the biggest challenge is that we had too much housing and not enough people. Okay? In 2024, we have almost double the amount of people. So we've got 40 million people, and we've only had 223,000 housing starts. Tell me if you think something doesn't add up. 34 years later, 13.1 million people, and we've only managed to have 53,000 fewer housing starts in a year. So yeah, let's chew on that for a minute here. The question of why aren't we building more homes? Obviously, a lot of reasons for that. Could be government regulations, fees, costs, burdens. Let's be honest, they're not making it really enticing for most investors to get into the housing market. And this is the real problem here. We just don't have enough housing starts. That's the real issue. So let's compare housing starts in 2006 versus 2003. We had 6.2% more housing starts in 2023 than we did in 2006, but our population is 22.8% greater. Oh my gosh, let's break that down. So we got 22.8% more people, and we only had 6% more housing starts in 2006. Based on the numbers, we should probably be at 300,000, if not more. Now, there is a lot of feedback out there that the government's going to step in and we're going to reduce immigration. Too late. We have 40 million people in the country. We've got a lot more people coming. There's kids that are going to want to buy homes. There's more people with jobs that are going to want to buy homes. At the end of the day, it is a serious issue that's going to need to be addressed. Thinking back, we talked about this earlier in the episode in 2006. And we found some notes about this. We had a lot easier mortgage qualifications. We had 30 to 40 year amortizations. You could do 100% financing. There was credit programs, a whole bunch of other stuff. It's substantially more challenging to buy today, yet people still want to buy real estate. So if you're trying to figure out whether or not it makes sense to own real estate right now and whether or not the value is going to hold, regardless of this LTI stuff, just think about those stats right there. Now, a big thing on our team that we're primarily focused on here is helping people basically bridge the gap to use real estate to reduce their costs and put them in the best position. Regardless of that, the biggest thing that you can do here is be educated. Listen, if you like this episode, if you want to get more information like this, make sure to follow me on YouTube at Flow Mortgage Co. or search up my name, Alex McFadyen. I know it's confusing, but on Instagram, you can find me as the Mortgage Pug and see lots of fluffy animals on there. I hope you liked the episode. If you did, share it with a friend, share it with a family member, tag me and leave me a review. I would absolutely love it. Anyways, that's enough for me today. I'll see you on the next one. That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.